The SEC just greenlit the future. Why RWAs are about to go parabolic. Summary statement. The SEC did not endorse tokenized real-world assets, and it never needed to. By closing its investigation into Ondo Finance without charges, the Commission signaled something far more important: non-objection. History shows that every major financial innovation that reshaped global markets, from Eurodollars to money market funds to ETFs, emerged not through explicit approval, but through regulatory tolerance. Tokenized real-world assets are now following the same path. The infrastructure is live, the legal risk premium is collapsing, and capital is about to flow. Section 1. The misunderstanding: what the SEC is and is not. A persistent error in crypto discourse is the belief that the SEC is an endorsing body. It is not. The SEC does not approve innovation. It does not greenlight products in the way people imagine. It does not certify the future. The SEC is a disclosure-based regulator. Its mandate is narrow and procedural. It receives disclosures. It assesses whether activities violate existing securities law. It enforces only when violations are found. This distinction matters because absence of enforcement is not neutrality. It is signal. During the Gensler era, this nuance was deliberately obscured. Enforcement actions were used as policy signaling tools. Ambiguity became a weapon. Innovation slowed, not because it was illegal, but because the cost of uncertainty was too high. The Ondo outcome cuts directly through that fog. Section 2. The key signal: non-objection beats permission. The SEC ending its investigation into Ondo Finance without charges does not mean tokenized securities are formally approved. Real-world assets have been blessed as a new asset class. Regulatory risk has vanished entirely. But it does mean something far more actionable. The SEC reviewed the model, reviewed the disclosures, reviewed the mechanics, and chose not to act. That is regulatory non-objection, and historically, non-objection is how financial revolutions begin. Section 3. The historical playbook. This is not new. What we are witnessing with real-world assets follows a well-worn path. Eurodollars in the 1960s, United States dollars held outside the United States banking system. Not explicitly authorized, not outlawed. The Federal Reserve tolerated them. The result was a multi-trillion-dollar offshore dollar system that still underpins global finance. Money market funds in the 1970s, shadow banking instruments offering yield outside traditional banks, legally ambiguous, politically sensitive, regulators hesitated. The result was a core pillar of modern liquidity management. Exchange-traded funds in the 1990s, synthetic baskets trading like stocks, novel structure, unclear systemic implications. The result was one of the most powerful capital allocation tools ever created. In every case, permission came after adoption. Clarity followed scale. Regulation adapted to reality, not the other way around. Real-world assets are now at this exact phase. Section 4. Why Ondo matters. Specifically, Ondo is not important because of its token. It is not important because of governance theatrics. It is important because of what it operationalizes. Ondo has quietly proven that tokenized treasuries can exist, tokenized exchange-traded funds can exist, tokenized commodities like silver via SLV can exist, tokenized equities can exist, all while interfacing with real custodians, real trusts, and real legal wrappers. This is not synthetic leverage. This is not perpetual futures theater. This is financial plumbing. And the SEC looked at it and stood down. That is the signal institutions wait for. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5. The collapse of the regulatory risk premium. Markets price risk before they price growth. For real-world assets, the dominant risk was not technology. It was not demand. It was not infrastructure. It was regulatory overhang. With the Ondo probe closed, legal tail risk compresses. Compliance uncertainty narrows. Institutional due diligence thresholds are crossed. Chief investment officers and risk committees can finally say, proceed. This is how capital unlocks. Quietly, then suddenly. Section 6. Why this goes parabolic, not hyperbolic. Real-world assets sit at the intersection of three unstoppable forces. First, demand for real yield and real assets. In a world of debasement, people want claims on things, not promises. Second, global access without intermediaries. Tokenization removes geographic, custodial, and brokerage friction. Third, regulatory tolerance, not hostility. The most important shift of all. When those three align, growth is not linear. It is reflexive. Liquidity begets legitimacy, legitimacy begets adoption, adoption begets scale. Section 7, the quiet truth. The SEC did not greenlight real-world assets. It did something more consequential. It stepped out of the way, and history tells us exactly what happens next. Section 8, governance tokens at the inflection point, from spinning rims to economic flywheels. The final unresolved piece of the real-world asset stack is not custody, not compliance, and not demand. It is value capture. For years, governance tokens have existed in a regulatory limbo, designed to coordinate, but forbidden to monetize. They granted voice without yield, control without cash flow, aesthetic decentralization, but no economic gravity. That era is ending. The same regulatory thaw that allows Ondo to tokenize exchange-traded funds also allows protocols to complete the economic circuit: platform fees, treasury revenues, issuance spreads, secondary market liquidity fees. These are no longer radioactive concepts. The Uniswap precedent matters, not because of its mechanics, but because it proves a principle. Economic participation can exist without violating securities law, provided it emerges from usage rather than promise. This is where the concept of accumulated intrinsic rewards becomes essential. Not dividends, not interest, not guaranteed yield, but value that emerges naturally from protocol usage, scarcity, and network growth, analogous to Bitcoin's appreciation, but applied to productive platforms. Governance tokens that evolve into buyback and burn instruments, fee-sink assets, and supply-constrained coordination tokens will cease being governance tokens at all. They become protocol equity without incorporation. Ondo's current token may be inert, but the optionality is enormous. The regulatory environment that once forbade motion now invites it. Section 9, the second-order effects. Why this does not stay contained. Tokenized real-world assets are not a niche product. They are infrastructure. Once stocks, exchange-traded funds, metals, and bonds are tokenized, self-custodied, globally transferable, and composable with decentralized finance, everything downstream reorganizes. Brokerage accounts become redundant. Why maintain fragmented accounts when assets settle instantly, custody is native, liquidity is global, and access is permissionless outside the United States? Decentralized exchanges become financial operating system layers. Hyperliquid, Avantis, and their successors are not exchanges. They are execution engines for global capital. Ondo supplies the assets. Decentralized exchanges supply the liquidity. Wallets supply the interface. Together, they replace brokers, clearinghouses, settlement systems, and portions of asset management. This is not disruption. It is recomposition. There are also monetary implications. When gold is tokenized, silver is tokenized, and treasuries are tokenized, the boundary between store of value, unit of account, and medium of exchange becomes programmable. This is how monetary systems evolve, not through declarations, but through usage. Section 10. The statement we can now make and why it matters. We can now say this clearly without exaggeration. Tokenization is not waiting for regulatory permission. It is advancing through regulatory non-objection. This is the same playbook that birthed Eurodollars, money market funds, and exchange-traded funds, and now tokenized stocks, tokenized commodities, and tokenized sovereign debt. The SEC did not endorse Ondo. It did something far more important. It stood aside. That is the Greenlight history recognizes, not in hindsight, but in pattern. Capital follows paths of least resistance. Infrastructure compounds quietly, and once abstraction layers settle, they do not revert. The future that once felt speculative now feels inevitable, not because regulators approved it, but because they failed to stop it. And that distinction makes all the difference.